So what is a Fibonacci retracement tool? Good question, because in this video, I'm gonna explain what a Fibonacci retracement tool is, why people use it, and how you can apply it to find better entries. And don't worry, we're keeping this beginner friendly, no complicated math and no confusing theories. Just the practical stuff, and I'll get straight into the point. Let's get right to it. A Fibonacci retracement tool is used to measure pullbacks within a trend. Think about it like this. Markets don't move in a straight line. Even during a strong uptrend, price doesn't just go up forever. It moves higher, pulls back, then continues higher again. The same thing happens in a downtrend. The goal of a Fibonacci retracement tool is to help traders identify areas where those pullbacks might end before the trend continues. Instead of chasing price after a big move, you can use a retracement tool and potentially get a better entry. That's the entire purpose of the tool. So why do traders use it? Imagine this. Price has just made a strong bullish move. At this point, buying immediately might not be the best idea. A lot of experienced traders prefer to wait for price to pull back first, because your stop loss could be extremely large if you're entering after the move has already happened. So this is where the Fibonacci comes in. When you apply the tool to a trend, it creates several key levels. These levels act as a potential retracement zone. These are areas where price may pause, find support, and continue in the original direction. Take note of the word zones, not exact prices. This is a very common mistake that people make. They expect price to touch a Fibonacci level perfectly and instantly reverse. Markets don't work that way. Think of these levels as areas of interest, not precise turning points. Now, how do you set up a Fibonacci tool yourself? If you're using TradingView, look at the toolbar on the left side of your screen. Click on the Drawing Tools menu and search for Fibonacci Retracement. Select it, and now you're ready to draw the tool on your chart. But before you start using it, I recommend cleaning up the default settings. Most platforms come with a lot of extra Fibonacci levels that can make your chart look cluttered and confusing. If you're a beginner, too many lines can actually make trading harder, not easier, which is ironic. So here's what I recommend. Double-click on the Fibonacci tool to open the settings menu. Go to the Levels tab. You'll probably see a long list of levels with numbers all over the place. For this strategy, we only need a handful of important levels. Only keep the retracement levels on the screen right now. Everything else can be removed for now. When you remove the unnecessary levels, your chart becomes much easier to read, and you'll be able to focus on the areas that actually matter. Once you've cleaned up the settings, save them as a template, so you only have to do this once. Now every time you use the Fibonacci tool, it'll automatically load with the same clean setup. Alright, so now that you know how to put a Fibonacci on your chart, let's get to how to apply it correctly. Let's start with an uptrend. Identify the swing low. This is the point where the move started. Then identify the swing high. This is the point where the move stopped before pulling back. Now draw the Fibonacci tool from the swing low to the swing high. Once you've done that, the retracement levels will automatically appear. Now all you have to do is wait. You have to be patient at this part. For most people, they see the price hit the 38.2 level and immediately buy. That's dangerous. Why? Because price can easily continue lower. It might move to the 50% level, or even the 61.8. The Fibonacci level alone doesn't tell you that the pullback is finished. You still need confirmation. You need evidence that the buyers are stepping back into the market. So what exactly should you look for? You should be looking for things like bullish rejection wicks, bullish engulfing candles, strong bullish momentum candles. These clues can help to show that the retracement may be ending. Only then should you start thinking about an entry. Now let's go through the biggest mistakes traders make. The Fibonacci should never be used by itself. The best results usually come when Fibonacci is combined with other factors, such as market structure, support and resistance, trend analysis, candlestick formations, supply and demand zones, risk management rules. The more reasons you have for a trade, the stronger the setup becomes. So to recap, the Fibonacci retracement tool helps traders identify potential pullback zones within a trend. In an uptrend, draw it from the swing low to the swing high. In a downtrend, draw it from the swing high to the swing low. Use the retracement levels as areas of interest, not exact prices. Wait for confirmation before entering, and always combine Fibonacci with other forms of analysis instead of relying on it alone. Used correctly, it can become a powerful tool for finding better entries and planning trades more effectively. If you found this video helpful, make sure to hit the like button and subscribe to Trading Uncovered. I'll see you in the next one.